Now, let's say it only goes up from 60 to 63, maybe 64, maybe even 64.50. Your trade that you put on is worth nothing at expiration. This is the How to Trade Stocks and Options podcast, brought to you by 10MinuteStockTrader.com, where we cover finance, stocks, options, entrepreneurship, education, and money. And here's your host, voted one of the top 100 people in finance, Christopher Ewell. Hey there, traders. Welcome back to today's How to Trade Stocks and Options podcast. Today, we have a special lesson for you. I'm putting it here on the podcast because I really believe that this is going to provide you massive, massive value. And that's what I'm trying to do here. And hey, listen, if this podcast was useful to you at all, I really highly suggest that you go check out the full trading course at AIStockTradingSystem.com. That's AIStockTradingSystem.com. Hey, make sure you subscribe and hit the bell so you'll be notified every time we give you more tools, tips, and tricks to help you trade faster and trade smarter every single week. Hey there, traders. Welcome back to today's How to Trade Stocks Options podcast. Today, we have a special episode where we're going to be talking about 10 options trading mistakes. This is going to be part one. This is going to be a series over the next couple of weeks. So while you're watching this, whenever you're ready to move on to the next video, just make sure you click the cards whenever they show up in the video, and also at the end screen. Make sure you go through the whole 10 options trading mistakes that are common to new traders. And trust me, as we go through these, I'm going to have plenty of personal stories to share with you as we go through each one. So first things first, what is an option? Now I'm going to read the definition of one here. Its options are contracts giving the owner the right to buy or sell an asset at a fixed price for a specific period of time, and obligating the seller of that option to take the opposite side if and when the right embedded in the option contract is exercised by the owner. So at the end of the day, the buyer of the option pays cash to pay a premium to get the option, to get a hold of the option, and that gives them the right to take the shares if that's the case. And then the sellers, they receive the cash that the buyer is paying, and they have the obligation to give those shares to the option buyer if and when they do decide to exercise. Okay, so the first mistake that new traders make, and I have absolutely made this, is buying out of the money long calls. And I say that this is probably the number one mistake that traders make whenever they first start trading. In fact, this was the first way that I blew up my account. And in fact, this is how, I'm going to relate this story to it here. This is how I blew up my account 67%, so 2/3 of my account in the first 60 days of trading. So this was around election time. I don't remember the whole situation, but I was convinced that the market was going to go up. And so I was buying tons of out of the money calls. And I was like, you know what? Stocks only go up. This is only going to be good for the market. I cannot wait for all the money that I'm going to be making from this. And so over the next couple weeks or so, because, you know, I didn't buy long-term options. I bought them couple weeks in duration out. The stock prices started to move up a little bit. Then the election happened, and they didn't move like I was hoping they would. I was hoping for an explosive move, but it didn't ever happen. It didn't actually come. Because of that, my options, where I thought I was making a sound investment, was almost like lottery tickets. I mean, truly, at the end of the day, let's say I put, for example, $1,000 into these options. By the time that I closed them, it was worth $333. And I was devastated. I had no idea what I was doing, first off, whenever I was making the trade. And then second off, I had no idea why, at the end of the day, I didn't have any money left, right? Like investing in stock is totally different than investing in out-of-the-money call options. We're going to talk more about that. So let's talk about option contracts and what is an in and out and an at-the-money call option contract. So if the stock is 60 and the strike price of the option that you buy is at 60, that would be considered an at-the-money call option contract. And so as the price of the stock rises, if it goes from 60 to 65 to 70, it goes deeper in the money. So the at-the-money, remember, is where the stock is trading at. But as it goes deeper in the money, as the stock price moves up, your 60 strike is staying still, but the stock price is going up. So if it's up at 70, your 60 call strike is now $10 in the money. But the inverse is true. Let's say it goes from 60 down to 50. The 60 is staying still, but the price of the stock is going down. It's gone down $10. And because of that, your once at the money call option is now $10 out of the money. And whenever you're buying a long call, you want that to be as deep in the money as possible, because the further down into the money that it goes, the more money that the call buyer is going to make. Okay, so let's talk about an example here. Let's say that we are going to buy Apple stock. And right now, Apple stock is trading at, let's use $60 to be consistent from our example a minute ago. Let's say Apple stock is trading at $60. And we are very bullish. We say that we're interested in Apple. We think it's going to go from 60 to 75. So $15 difference, right? We wanted to be bullish and express our bullish opinion by buying an out of the money call at 65. Now, the reason we bought it at 65 is because it was cheaper. And by buying a 65 call, I paid $1. And that $1 is essentially $100 per contract, 100 actual dollars. So it's $1 per share because the contract is on 100 shares. So my max risk in the trade is $100 total. But for that risk that I've taken, I now have control over 100 shares. And if Apple rises from 60 up to 75, like I hope it does, this would be a great, very profitable trade. Now, my break even on the trade is going to be $65, which is the strike price that I chose, plus $1, which is the price that I paid for that call option. So my break even is 66. So really, I need the stock to move from 60 to 66 to see any profits at all. So it's got to have a 10% rise just for me to turn in a penny of gains, which right there should be a huge red flag to say, hey, buying out of the money options can be kind of a hard play if you need the stock to rise 10% just to reach your break-even point. So here, let's look at a chart of what this would look like with the out of the money option call that we bought versus the price of the stock. As you can see, like I was talking about a minute ago, the stock has to go up 10%, which is the same place where the option would actually be making money. Whereas the stock, it's already made 10% in the process. Now remember, the stock has to go from 60 up to 65, which is our call strike, plus an additional $1. So it's got to go from 60 to 66 for this trade to make money. Now let's say it only goes up from 60 to 63, maybe 64, maybe even 64.50. Your trade that you put on is worth nothing at expiration. I mean, $0. Remember how we talked earlier about how I was buying these out of the money calls? That's exactly what happened. It moved up, but it didn't move up far enough. And because it didn't move up far enough, my trade, which could have been potentially a huge winner, turned into a giant loser. Because with option contracts, it's not like stock. You don't have an equity value. You need it to go up to the strike price plus in order for it to make money. You've got to make it up to the strike price plus the option premium. Otherwise, it will expire worthless. So this investment that you made, really, in all honesty, is just a lottery ticket. And if this doesn't go in the money, if this doesn't get in the money plus the premium you've paid, this lottery ticket you bought is worth $0, which can really, really devastate and take out your account much faster than you ever wanted it to. So that's the number one mistake that I see traders make all the time. And certainly I was super guilty of it, is buying out of the money option calls. And we're going to be talking about lots of different mistakes over the next few weeks as we go through this series of our 10 option trading mistakes. But there's a lot to take away here, right? If you are going to trade long, buying an out of the money call is not the place to be. Maybe you just want to buy the stock. Maybe, on a future episode, we'll talk more about this, is selling put spreads. That's my number one go-to. Or if you're really bullish, maybe you buy an in the money call, which that's another episode. But in reality, if it's an in the money call, then you're a lot more likely to be profitable because your strike price is already in the money. We've removed the variable of it going up to the strike price and beyond. But if it's in the money, you've only got to make up the premium that you've paid. And that makes it a lot easier to stomach than having to go 10% plus the premium before we even make any money. So either way, at the end of the day, the number one mistake that we see traders make is buying out of the money calls. Don't do it. It's not financial advice, but it is practical advice from somebody who's been there, done that, and lost a ton of money in the process of doing it. And I don't want you to repeat the same mistakes I did, which is exactly why we have this podcast and why I want to make this episode. So, hey, if you found this useful, please be sure to share it with somebody that you are hoping to be successful in their own trading career, or maybe you are trying to be successful in your own trading career. And do me a favor, make sure you like, subscribe, and enable notifications. That way you never miss any of the tools, tips, and tricks I upload every single week to help you trade faster and trade smarter. I'll see you on the next episode. Okay, so what'd you think? That was pretty incredible, right? Now, if you like that, that's only a taste, only a sample of what you're going to find in the full AI stock trading system. And I really highly encourage you to go and check this out. Obviously, you are interested in learning and how to trade, and that's why you're listening to this podcast. Now, I'm going to take and download my entire trading system that I use day in and day out onto you. And the only way I'm going to be able to do that is over at the AIStockTradingSystem.com. You're going to get phase 1, 2, and 3, several bonuses, and on top of that, I'm going to walk you through over a dozen trades that I put on inside of my account, holding your hand and showing you exactly how I got in, how I got out, how I use the artificial intelligence data, and how this could work inside of your own trading portfolio on a daily basis. So make sure you head on over to AIStockTradingSystem.com. That's AIStockTradingSystem.com to learn more and to get started and to download my decade plus worth of trading experience into your hands so you can start using the AI stock trading system today, the 5-step system to take the guesswork out of trading. Hey, if you like this video, let me know by leaving me a like below, and then subscribe and share it with somebody you think could use it as well. Be sure to comment below with your biggest takeaway from this episode and any suggestions you have for future episodes. And finally, make sure you watch these other videos to help you trade faster and trade smarter, and I'll see you on the next episode.